basically the single greatest rise in any asset class, more than residential, in industrial.
This episode of the Under the Table podcast is brought to you by Shrubs.me.
They say AI is taking everyone's jobs, and honestly, no one knows whose is safe. But here's the thing. When you own your audience, your content, and your brand, you don't wait for someone else to save you. You build your own future. Shrubs puts everything you create in one beautiful hub. More reach, more fans, more income. Shrubs.me. Your future, your rules. And when you get there, I'll be right there with you, helping you thrive and grow.
Industrial, you know the story here. Like here's a good example of what happened, like industrial vacancy. So we had a very, very tight market for a very long time. When I was first a research analyst at Colliers in 2009, 2010, we did this big study and we were like, wait a second, rents have been the same for basically 15 years. They need to go up. And vacancy rate is, sub 4%. Canadians in their conservative atmosphere never pushed rates up. And in fact, in 2009, we saw a decrease in dollar volume amount until about 2016 for building sales, for industrial building sales, and then 2017, 2018 for industrial land. So it wasn't really until those years you started to see a pretty aggressive upswing in the price of development land for industrial, and as well as the rental rates for industrial. So, pretty significant from where we saw that growth.
Yeah, like stupid.
It's pretty insane. Like you look at like 2019, 2018, you saw basically the single greatest rise in any asset class, more than residential, in industrial. And so in 2022 is the same thing. It was like absolute insanity. And basically the overall thesis, to give you some kind of understanding, is that when you look at industrial rents in some of the major industrial core markets in the US, their rent costs in, say, a New Jersey are like the equivalent to $50 a square foot Canadian. Wow. So when you look at your rents in Canada, we're effectively at the high point of the market. They were really about $22 for the most specialized buildings. And now they've kind of settled back 16, 17, 18-ish, kind of depending. That market is still pretty cheap comparatively to some of the other markets around the world. So you had one of the largest industrial landlords in the world bought a $500 million piece of land up here because they're like, listen, Toronto's always going to be good. There's a very controlled stock here. We just know it's a matter of time before it grows. So that market, it really only equaled the residential land market, kind of got up to the $7.6 to $8 billion of transactions. And then eventually it's been softening now, right? So significant softening. Leasing is still strong, but not nearly what it used to be.
Were they building new in the GTA industrial?
Industrial all over.
The 407's a big hotspot.
Oh, right.
Yeah, Caledon is a pretty significant growth area. There are a few large infill sites that are still happening as well. Scarborough has a few, Markham has a few, but most of the growth is centered in Caledon and Hamilton. Slate bought that monster parcel from US Steel, the steel area. They bought 800 acres there and they're developing all of that. So Hamilton would be a growth market. Hamilton's airport is going to be a growth market because there's no more space for goods and services to flow through Pearson. They've been at peak capacity for their logistics business. So now it's going to Hamilton. Hamilton's growing as a market. And then you have Caledon, and north of Brampton is another part of the big growth in industrial. And there's some issues there as well, obviously, because of tariffs. There's been, significant changes in the auto sector as well as the agricultural sector. So these are things that will definitely be some headwinds for industrial, but you're still going to see what I would call one of the greatest growth areas in the GTA, I think, for asset classes. There's just not a lot of it. It's hard to build, and there's not a lot of land to do this kind of product. And so that market, I think, will always be strong. It's just a matter of kind of balancing out where it was. You had, from really 2017 to 2022, you had this just massive shift in growth and kind of settled down now. So we'll probably end up back at the 5-year, 10-year moving average, which is closer to roughly $3 billion. So, we'll probably get there this year. But it's hard to say exactly what's happening, and still massive deals happening. This was a large sale leaseback. Crest Point, a large fund, they bought this $253 million. They wrote the lease, 5.1 cap, and $340 a square foot.
Wow. Good deal for them.
Wow.
AAA tenant, really nice building. The tenant wanted to open up some cash, and so they own the asset. They sold it to Crest Point. Crest Point wrote the lease that they'd like to see. So, something is very nice. And then here's an interesting one too. This is a small bay industrial property. This is something that a number of buyers are very aggressive on. They want to see some of these smaller kind of end user business type product. This is one that we see a growth market as well.
Yeah, love it.
Long term, because there's just a lot of people want to own their own real estate. So it's, something where you can kind of rewrite the change of a large industrial building, turn it into small bay, or buy a small bay and open it up to more tenants, modernize the space, increase the roof size. There's a lot of things you can do.
Condo.
Yeah, so it looks like that, and it's not like an old 1970s building.
This is a condo conversion right here. It's done by a small group that really know what they're doing, but they effectively bought this building for $321 a square foot. And they're going to sell it at $550 a square foot. And they probably put about, $80 a square foot into it. So this is your classic condo conversion play, similar to what's happening in the industrial land market, which is kind of what we're going to talk about next. But, you have land where you build and then you sell off the industrial condos. So Forager, which Miles on our team used to be on the private equity side before he came and joined our team again. They will look for land, build a building, sell off the industrial condo. So it's the same playbook as the residential developer. The difference is it's industrial. And so people want to buy small industrial, they want to own it, and they want to be able to, control their own destiny when it comes to their own businesses. So that's another good example of what these markets are. And here's another one. BD, they like to do the same thing. They bought this at $2.8 million an acre. Is done in March. BD is a large developer from Vancouver. Carteria, a good client of ours. Same thing, bought this up in the north part of Scarborough, northeast part of Scarborough. And they were able to buy this and develop a modern industrial building and actually build out and put a tenant in that. And they'll eventually sell that because it's one of their funds. But industrial land, same thing. It's kind of followed this the high points in the market. The residential market has really gone down significantly. So industrial development is hard to do right now. There's a big bid and ask between the landlords and from where, called the owners of industrial land, where buyers want to be. So that market will take some time to come back. And it really follows a similar timeline. As I mentioned before, what happened in the great financial crisis, the only asset class that was really hit was industrial, and especially industrial land. So you can see here, the market was kind of in a growth mode until 2008, the crash, 2009, a low point, and then it didn't really get anywhere until 2016, 2017 again. And because effectively from 2009 to 2016, the equation to build industrial did not work. You needed a certain rent, and in order to get to that rent, you needed to be able to build your building, and the tenants in the market were unwilling to pay it. So it was a psychology. So I always say this is a really good model for what has happened in the residential market. You can see this exact same scenario playing out. We have a large crash in the residential market. None of the users, want to pay what is necessary in order to justify the development of the actual building to make a margin, right? Because the builder's not going to take a big risk on a construction loan to actually build it. So once you actually get to that, then you have this ramp up in this massive ramp up. So I personally think we are in a similar equation for residential. When the equation starts to make sense again, when the pricing has come down, when the costs have come down, and when the user, the person who's actually paying, either renting or buying the condo, the residential, when they're actually able to do that, we're going to have this similar ramp up like we did in industrial. And so you see 2016, up to 2019, obviously the pandemic was weird. And then boom, boom, huge growth years. So it's almost like this kind of slinky effect where, you have people follow the demand goes all the way up, and then we crash and we come back down. That's just how markets work. So, I mean, I think the same thing's going to happen to residential, but we're still probably 4 years into this correction right now. And there's likely probably another 2 to 3, potentially 4 years to go before things balance out again. Who knows? But the point is, this has happened before, and this will happen again. And I mean, this is Toronto.